Good morning, everybody. Thank you for joining us this morning. So maybe we can wait for another 5 minutes and see if there are more people joining in, and then we can start. Good morning, everybody. Thank you for joining us this Saturday morning. So we're going to be speaking about a very interesting and yet something that everybody is thinking about. What happens to your SIP now that the markets are down? I'm sure there's a lot of panic about the market volatility. If some of you had the time to attend our previous webinar, it was about what happens to my portfolio. Everything is in red, right? So today we'll talk about what happens to our SIPs now that the markets are down. So one essential thing that we should all be aware of is that we all know that there's a bull market and a bear market. And what is very interesting is that these SIPs work well in both. Right? Today's market is a very, very dynamic landscape. So one effective way to sort of navigate these market downturns is SIPs. So let me set the stage by maybe talking about something fundamental, which is the dance between the bull and the bear market. So as you know, these SIPs will keep investing whether it's a bull or a bear market. What is very remarkable, maybe if I can say so, about SIPs is that they work effectively in both of these markets. So one thing that we should keep in mind also is that how do we ensure that in such scenarios that we're making the most of our SIPs, particularly when these markets are experiencing a downturn. Right. When the markets go down, many investors, they feel panicked. But what we're going to discuss in today's webinar is that how these market fall can actually be an incredible opportunity in disguise for us. So before we go into the more specific parts of the webinar, I'll just take a moment to explain SIPs. It is, like you already know, it is built for long-term wealth creation, and we ensure that it's basically a disciplined approach to investing where you sort of commit to investing a fixed amount of money at regular intervals. It can be weekly, it can be monthly, it can be even quarterly. And irrespective of the prevailing market conditions. And now, one thing that I would like to emphasize at this juncture is that uh, the realities of investing, that is the market volatility, is something that we cannot ignore. The markets will keep going up, it will keep coming down, and it's very natural, and we end up getting caught, like our brains end up getting caught up in the day-to-day fluctuations. But what is essential here is to avoid letting this volatility sort of deter you from your long-term financial goals. So market volatility is definitely a part of investing, but how does that impact your SIP returns? Right. Some important questions that may arise in your head are, does a market downturn automatically mean that, our SIP is failing or it's not doing well? The opposite. The bigger mental shift here is that investors have to reframe the perspective and sort of view market downturns not as threats, but as potential opportunities to accelerate your wealth creation journey. And this is something that we have been advocating for a very long time in all our webinars, if you've been following us. So the next important question being how these market corrections impact SIPs. So this past week has been very volatile, right? We saw Nifty take a big hit, and the last 2 days we saw some recovery. The markets went up. So the key takeaway from this slide is essentially market downturns give investors to I'm sorry, I beg your pardon. It gives investors the opportunity sort of to accumulate more units for some amount of investment. So think of it like when the prices are down, it can feel a little scary, and your fixed investment effectively buys you more of an underlying asset. It's like it's more like getting a discount on some of your favorite products during a sale. Right now, everybody likes a good sale. So the good alternative or a good solution to this would be, instead of panicking or giving into the fear and potentially ending up making rash decisions during the market correction, you sort of train yourself to view the more brighter side of this and take it up on yourself to maybe accumulate more units at a lower price. And over time, as markets recover, these units will drive your wealth, and it'll grow even better. So what you have to remember is staying invested is key to maximizing the benefits of your SIP. So if you want to reap benefits from your SIP, it is important to stay invested, stay disciplined, and just keep at it. It is natural to feel panicked and get scared when the markets go down, but the real test is when you can stay disciplined and sort of let your money grow, and that's when your money will start working for you. And by doing this, you're also strategically reward the market bounces back. What happens when you sort of are disciplined in your SIPs is that it smooths out the impact of market volatility, and it basically allows you to take advantage of both the ups and the downs in the market. So the next slide will show you an illustration of how consistent and systematic investing can lead to financial success. I'll hand this slide over to my colleague Harshil.
Thanks, Aishwarya. So, how many of you have started your SIP in September versus how many of you are actually looking to start your SIP now? Sorry, my question was, how many of you started your SIP in September at the peak of the market versus those who are looking to start your SIP now? Okay, there's a comment saying started in September. Are you worried that you started in September? Are you hitting yourself in the head saying, I should have started now, I made a mistake? Okay, have started new ones a year ago. Oh, okay, all right. So are you hitting yourself in the head that, oh, okay, would have waited, right? Not much. Okay, fantastic. Very good, very good to see that you're not scared, that you're not hitting yourself on the head. You're not regretting your decisions. All right. Started last year. Okay. Are you regretting starting last year? No. All right. I started new SIP last month. Are you regretting that you started your SIP last month? Okay. What? Yes and no. Can you elaborate on this? Yes and no. No regards because of the conviction through M2W. Thank you so much for that confidence in us. And yes, because yes for index based funds, no for active small cap funds. Okay. So you tried to do a mix of somewhere what you see on value research and what you see on money control. Yes. All right. Right. So you look at this data, right? No, I was actually waiting for the correction and invest more in further corrections. Perfect. You were waiting more. All right. Is that good behavior or not? Right. Stopped all SIPs and SIPs 2 years back. Very good. Hedging against gold ETF did help. All right. Okay. Now you look at this data. This data shows, and this is something that we covered before also. This is it's public data. You can just go to White Oak and they'll publish a lot of papers, and this is one of those papers, right? What happens when you start at the end of the at this you start at the peak of a bull and at the bottom of a bear, right? So you look at January 2008, March 2009, peak bottom. January 15, peak bottom. February 16 was bottom. Jan 20, peak. March 20, bottom. Right. So you look at the number of years that you're doing your SIP. So many of you said 1 year, right? Most of you have had a 1 year, 1.5 years. Yeah, I'll take 1.5 years worth of SIP that's going average. Right. Some of you would have been doing for 3 years, but average. Right. So what do you think the return will be at the end of the 10th year or the end of the 15th year, depending on when you start? What do you think that return will be? Right, you look at the valuation looks the same, right? 72 lakhs, 61 lakhs, 25 lakhs, 21 lakhs, right? 9 lakhs, 8.5 lakhs, more or less, whether you start putting in your money at the peak of the market or you start at the bottom of the market. You cannot time it. You just have to keep on doing. SIP is that level of that product that requires you to be only disciplined and consistent. That's what Aishwarya was talking about, discipline. Right. So during that entire bad phase is when you're able to average out, and in good years is when you're able to perform well. But it takes a long time. It takes some good amount of time for you to see actual performance coming in, and hence the 3.5 years to 4 years is what takes for you to be extremely disciplined. Right. So what do you think that return would be? Right. Assuming you start at the peak or assuming you start at the bottom. Pure SIP, no shifting out from one thing to the other thing, no hedging, no nothing, just being consistent and disciplined. Whether it is a peak of the market, whether it is a bottom of the market. What do you think that return will be? Any guess? Small caps are clearly overvalued. We have to time the exits, I believe, if not the entry. No, we'll get to that. We'll get to that probably at the Q&A. But I can tell you no. I'll give you another perspective. Average should be somewhere between 10 to 14% average. All right. Peak 15%. Okay. Next. 12%. Okay. Next. Peak 12. All right. Okay. Aishwarya, I think we can go to the next slide. Look at this. It's not seen. No, I think I was able to say, yeah, this is it. So you look at this, your XIRR, your SIP XIRR at any place you do, there's barely a difference of 0.4, 0.5%, right? Whether it is at the bottom, whether it is at the peak, right? So 13.5%, 14% is what you do. Peak 16, right? Good time 16, great. But as you go progress forward, somewhere between 12 and 13% is a very, very good rate for you when you want to do your SIPs. Now you look at this, that's the most important part. Right? This is why we say that gap, whenever you do and whenever you start your SIP, should be met, which is through step ups and active participations in lump sum. Right? Because we are doing more SIP based, now we will talk more on step ups. Right? That gap of behavior is what needs to be covered, whether you start at a peak or whether you start at a bull. So when you do at a peak, what happens is over time there will come a scenario where things are looking so cheap where you will have to participate a lot more, right? And when you're on the other part, when you start off doing an investment, so front ending works a lot. So you put in a lot. Your participation at the start of your journey is much more higher than, and as you progress, you will see that benefits starting to take place, right? Because the difference in the final value for a long period of time is somewhere between. Look at this. This data shows it's 10 lakhs or so. In 10 years, you would see somewhere between 3 lakhs, right? And going forward after that to 15, 17 years, which is what is considered as long term, right? That value becomes 9 lakhs or so because of compounding, that difference, right? So that is the only thing that you need to consider when you look at peak, bottom, right? Not shifting from one and going to the next one, shifting from one, no. Right? It's always how we can cover up that particular gap, because we know that gap can sort of exist, right? Going forward, it will definitely come up. Right. So in that journey, right, whenever we are able to get very, very good entry points for you to participate in, you should look to participate. Right. Then that gap will start getting met. Then your average returns will look somewhere between 14.5 to 15%, which is a solid number for you to achieve. Because if you're able to compound somewhere between 12% or so, then your money doubles every 7 years. Right. 15% you take off six months out for every percentage. So you're able to meet your goal faster, right? The whole point is that yes, as you participate more and more, what takes you 10 years will ultimately take you 5 years because of that participation, right? And that 2 years of what you're able to get is time for you for wealth creation. Once you've met that particular goal, after that is only wealth creation, right? So yes, most of you are right, somewhere between I'd go with the 13 to 14 sort of answer when it comes to whether it is peak or whether it is bull. Right? Why? Because everything works as a cycle. You have to take advantage of that particular cycle on the way down. This is what the next slide is all about. Right? We are always caught in to go in whenever. So many of you have started doing SIPs last year. Right? And why? Because things have done so well. So that fear is there that you will miss out. So that level of confidence has come. So you will go. That's where the greed starts coming in. Now is not a period where we're seeing too much fear. But yes, there is a fear, because some of you have actually asked, right, if I'm going through that big of a loss, should I actually consider selling or not? Right? So you're seeing this right now and happen, right? And what we look to do is during that phase where there is a down in the cycle is where our participation goes up. So we are flip, right? When you saw the bull and the bear, right? When the bear is more active, then you have to be more active. When the bull is more active, that time your activity definitely it does not warrant too much of activity. Activity only comes on the part of which asset class and asset category is on that big bear where you should be participating more. So it's never stopping to participate. So it's never stopping your SIP. It's always channeling your incremental SIP, your incremental money towards other asset classes where you are able to manage your downfall better and your drawdowns much better. Only then you will be able to sustain this 12 to 15 sort of allocation, which is what we endeavor to do. We do follow a multi-asset approach. We make sure that the money that is going in is in undervalued parts of the market, is in undervalued asset categories, right? So when the time comes to reap the benefit out of it, reaping the benefit happens only when we are close to meeting your particular goal. Otherwise, all the money incrementally goes to another asset class, to another part of undervalued market, whether it is an undervalued asset class, whether it is large, mid, small, wherever it may be. Right. So we are not very obsessed with, oh, it has to go only here. No, we are very, very obsessed about which category is undervalued, and we will only go towards that particular category. So SIPs never need to stop. It just gets your incremental SIP only gets channeled to another undervalued part. Right. I think we can go to the next slide. Okay. If you are consistent with the SIP in a prolonged market, the subsequent market recovery will push up your SIP value much faster. We've seen that number. That all of this is just validating whatever we are able to gather out of that particular chart. Investors need to learn to embrace short-term volatility and not run away from it. Hence, what we say is embrace it by just being able to participate in every fall that comes. And that you have to do once you're able to manage your current finances at home. You need to know how much is there for you to keep on continuously putting. Right. Averaging plays an important role. This is how SIPs work. SIP is monthly, consistent, disciplined amounts that go in, where you're able to gather more units at a particular price. And if the price is low, I would only say run for it. Right. We can go to the next slide. Right. This is very important. Time in the market is more important than timing the market. There was a comment here that said, I was actually waiting for the correction to invest more. No timing the market. SIPs does not require you to time the market, because by the time it recover happens, the 3 month of that, the amount of money that you're able to get to save within those 3 to 6 months gets acquired at a much higher price. So no timing the market. Time in the market, which means it should not stop. You have to alter your particular behavior, right? By either participating more or participating less. But your SIP should not stop. The gains made at the end is definitely a reward that every investor should benefit from. This is why it's very important for you to invest with a particular goal. Right? If you're having a goal for probably education or buying a house, right? And if that goal is 5 years away, right, and you know that you have to continuously keep investing, will you take your money off and they say, no, I'll do only when the time is right, and that probably the time comes 4 years or rather 1 year before your actual goal has to be met? That's a very risky scenario to be in. I would say that's completely unwarranted, for you. So time in the market is more important than timing the market. I think we can go to the next slide. Yes, it's very clear that SIPs are the most effective when the market is at lows. Does that mean we should not contribute when the market is rising? Again, no. When you see that entire slide, right, even when you start at a peak, right, you're going down. Even when you start at the bottom, it's going up. Right. So net your entire goal is that no, this level of behavior for me is going to somewhat get me between that 12 to 13, 12 to 15 sort of a number. And that is very important for me to achieve. It's very, very difficult to achieve that level of number. So don't take that for granted, saying, because discipline is commitment. It takes a lot of time. It takes a lot of getting for you to get to that stage, for you to be committed, to trust in yourself, to trust in the process, so that you're in times like this, your participation keeps on going up. Otherwise, now you're thinking back itself to participate in the market. Right. So you should contribute, you should let your SIP return at all time. And usually what happens is, in a bull market, you keep stepping up. In a bear market, you keep stopping it. Right. But it should go as per your financial goals. It should not go as per the market. If your goal is coming up too fast, then your plan has to be only to meet the goal, not to beat the benchmark or not to do anything of that sort. It's how we can meet your particular goal and what it takes to meet that particular goal. If it's a conservative goal that is coming up is important, but it's coming up in a year or so, that level of risk does not require itself on the equity front, right? Because the priority is to meet the goal, not to beat the benchmark. Right? The priority is how can we meet the goal in the most effective manner. Right? That should be the priority. You can go to the next slide. Okay, this is a behavior model that I was talking to you about. It's flip, right? In a boring market, which is aware of where fear is majorly, is where our participation levels definitely need to be much higher. It can be a combination of lump sum plus SIPs, SIP plus step up. It can be anything, but your participation definitely needs to go up. Right? You need to have a hold on your finances. Only then you will be able to participate more. Right? That reaping the benefits come very, very close to you meeting that goal. Once your goal is met, is where you reap that particular benefit. That usually happens in an exciting market. If not, also yes, there will be more provisions where we are more conservative for you in channeling your money so that that goal is met. No matter what happens, that goal should be met. Right? As we can go to the next slide. Okay, now we'll open the floor for Q&A. Okay, just hold on. You can put in your questions in the chat box and I'll do my best to address it. Just hold on. Okay, there was a question in the beginning. For small caps are clearly overvalued. We have the time. We got to time the exit, I believe, if not the entry. See, what happens is when you're doing a SIP, and if a SIP is going in an overvalued category, and small caps have been overvalued for a good amount of time for the last 3 years or so, and we have actively stayed away from doing SIPs in small caps. Why? Because when you start in an overvalued asset class, no matter how long your horizon, right? Your 40 to 50% of the time that you're staying invested in it, the experience is bad for you because you just see small amounts of CAGR being made. So 18, 19, 20, 21 were periods where you had a single digit sort of return coming in on from a CAGR perspective coming in from small and mids. And if somebody has stayed invested for 5 to 6 years, then your experience in the market is not going to be good. Right. So we are very cognizant in making sure that we're conservative in terms of valuations. That's what I would say. Right. So you have to be very careful when you're doing SIPs in overvalued parts because your entire experience will be bad. You'll not want to go to another asset category itself. You'll not want to go towards a large or mid, wherever. Is it the right time to rebalance the portfolio in a bear market? That the funds still keep up positive? Right funds are too conservative. All that funds are right. Do they need correction? See, we can review your investments, and depending on your goal, depending on your risk appetite, is what we would do for you. But because it is in red, does not mean that you have to rebalance. 3 years only people have seen a green. That's not a very good side to be in. Reality has to kick in somewhere or the other, and reality is kicking in. So you have to work with a professional to understand, what your risk appetite is, whether you can take your ability to take risk and your willingness to take risk are two separate things. Right. So now everybody is sort of getting scared. Did I do the right thing or not? And should I take off some money or not? Right, but you have to work with a professional to understand it. If you're having a headache, that doesn't mean you're just popping dolos for days together. Right. So you need to go to the right person and just send us your portfolio, take the risk appetite test, take the financial health checkup, and then we'll see whether it is the right thing or not the right thing. Good morning. I'm doing a lump sum. I'm doing SIP via Milestones2Wealth. Can I also add a lump sum now? Yes, you can. Okay. Is there any data to demonstrate that if we stayed invested for more than 5 years in small and mid caps, will result in decent return? Yeah. You just send us a hi. We'll send the data to you. Of course, that level of data is there everywhere. But you don't know, no, whether you 10 years later the return will be good or not. It's an assumption that it will be very good. That's what even we said, right? Over a period of time, there is a possibility that yeah, it will, but it will only when the category or the investment that you've been putting your SIP into is undervalued. If it is always overvalued, then for 5 6 years you will the cycle, right? Overvalued cycle. Remember, always remember this. Right, and we always go with the assumption that no, when we when we have seen it when we invest in undervalued parts of the market, undervalued asset classes, right? It tends to do far more better than whatever is being hyped up outside or is being glorified and told, and it's everywhere on digital media, newspaper, everywhere. So there is a good quilt that Life Mint does. If you just put asset class quilt over different periods, you will know. So you will see large cap here. You will see some periods where small cap is here. You'll see in during 2010, 11, 12, 13, after the GFC for 1 2 years, gold did extremely well. After that, gold did not do very well for 5 6 years. So you will see that data there. Okay, can I go for a lump sum in large caps? Yes. If you're on the program, you would have already gotten multiple replies from us, multiple conversations from your relationship manager. That depending on your financial condition, depending on your goals, is it a good time? You would have already gotten that yes. On long term, SIP is what's a decent expense ratio that is okay for an active fund, which will not corrode the profits on for a long term. It does not matter. Expense ratio in a broad based fund does not matter at all. As the AUM goes up, the expense ratio comes down. Our decisions are never based on expense ratio. Right? We have stayed away from broad based thematic funds and NFOs because we understand that they are sold very well to all of you. Right? Given a good story. Nothing against it, but you would always want to stay back and let the whole theme perform, see what the fund manager is doing, how the construct of the fund is, and only then take that bet whether it's there or not. Otherwise, it does not come. Expense ratio is not a factor where we consider that it warrants an investment or not. But broad-based funds, which is large, flexi, with decent houses, large houses, there the expense ratio is very low. It does not even matter. Does not matter. And whatever your expense ratio is, it's not 13 minus 1. No, it's already factored in daily on the NAV. Right. So, and our perspective is that when you partner with an AMC, or even if it is us, right, when we also have to partner with an AMC, they have a team of analysts. So it's a 10 15 people who are day in day out just tracking the names, and then there's the fund manager where there is a group of fund managers who take decisions, and it gets approved only when the investment committee says okay. So there are three steps here, and only then it goes into. So we work only when there's this level of check that takes place, with good level of experience that takes place, and you're getting it at a very cheap. 1.2% is very cheap. In the US, it's much higher. So we compare ourselves to develop. We charge that? Right. So it's very cheap. The level of advice and the level of work that the industry does comes at a very cheap cost, considering what the benefits that they're giving you. Okay, so I understand sector rotation is also key even with SIPs. See, I would say incremental money that goes into assets like equity there you have to be cautious. So incremental money needs to go there. Sectors require that level of work. Rotation means it's very, very difficult. So it requires a lot of work. So when you do it yourself, it becomes very difficult because you will not know when the peak of the cycle is, right? And when the bottom of the cycle is, right? You'll always read a lot of stuff when it is at a peak. So it makes you believe that this is a great sector to be in, but there the activity and active management needs to be very high for an advisor like us. And we've always done sector and thematic funds only. We were majorly on the PSU plus whatever was undervalued. That time it was PSU commodities. We took high risk sort of calls, and now it has shifted away from that approach to go where we can take that level of risk, right? Where it is undervalued, where there's good enough safety, where the drawdowns are lower. That is what we are looking to do. When we have that focus that the drawdown should be low, the returns automatically are very strong. It's stable, right? Okay, how much of weightage you put on fund managers when select the fund managers versus the fund house itself? Then what if the fund manager changes? That's a big problem. And we faced this before also. We understand what the philosophy of the fund house itself is and how well the fund manager fits into it. Some AMCs give fund managers a free hand, and we understand that that is required, right? For them to be in their natural self, work according to their strengths, right? And broadly, if it is in line with what the fund house itself thinks, then we partner with them. Change in fund manager comes when this fund house philosophy plus fund manager philosophy is not a good handshake. And we have faced that in the past. Some cases, it's a clean handover. No problem at all. Some cases are pristine. But there are cases in the industry where it takes time for the the other fund manager to come and try to do it much more better, or rather his style coming into the fund. It takes time. So we are all constantly in touch with them to understand whether it is done. What do they think? What do they how are they seeing that avatar versus the avatar that they're trying to create? Lot of conversation goes on with the AMC. Lot of conversation goes on with the fund manager. Only then we take the decision. Otherwise, no. Right. Majorly, we look to focus on. See, this is our level of work, and what we want you to focus on is majorly what sort of participation requires for you to meet a particular goal. If it's retirement, then yeah, it's a long-term thing. But that doesn't mean that whatever we do is unwarranted. We can do whatever we want as advisors. No. Right. We want to always give you that direction that no, you have to do this to meet this goal. This much has to go in for you to be able to grow at these levels. Right. So that's the level of work that we are looking to do. What will be the expected returns with respect to doing SIP and mutual funds, staying invested in PMS, both for a period of 8-year investment periods? I would say that if you can do your SIP in a PMS also. See, PMS is if you are let's say you have a crore or you have only 50 lakhs and you don't have anything to scale, right? And you won't be able to step up your SIPs also going forward. Then mutual fund is the best way for you to do it, whether it is 50 lakhs or 1 crore. But if you are in that financial condition that yes, you will always be able to step up, your active participation is very high for a PMS. Right, so it's not the returns, it's Virat Kohli can participate in T20 in India, in Australia, wherever you tell them to do. Test match can perform, ODI can perform, right? But certain people, Abhishek Sharma can probably do more T20s now, right? Given the chance for ODIs. Hence, this is it's like that. So it takes that level of performance for you on PMS. From your part, that level of active participation, more participation is required for you for PMS, because there they are looking to exactly size it up to that level, the 5%, 6%. You have to continuously keep buying there, right? Whereas mutual fund SIP is sober, where you concentrate more on your behavior and that level of step ups keep happening from your part, and it's very simple, right? So more complications, more complicated stuff comes in on a PMS, right? So if you're somebody who can take up that level of complications and that complex strategies, then PMS is that product for you, where you have to do SIP, active participation. If you're not that, enough wealth can be built on mutual funds. It's easier, it's tax efficient also. But if you are that where yes, you can take that level of you can play that game, then PMS is the thing for you. Okay, will you get to know prior to the fund manager change, or you have to take a call on it and alter investment advice? See, altering investment advice doesn't come just because the fund manager change. We understand what the change actually means. One, why the change happened, and then okay, give them some time to try and understand uh, whether the change was warranted. Yes, okay, what are they planning to do? Coming in, and we give them some time to understand. It's not that see, it's a proper relationship. Right. So just because, for example, just because your child during their teenage years or something, will they be that after they are 25? No. So it takes some time for changes to take place. So it's that trust and commitment that we uh, build with you first, and then get it from them. They have to build the trust with us, and we have to build the trust with you. If you are not getting that from there, then it's not coming to you. Are there any scoring methods or ratings of fund manager based on the performance given by any third party? Look, performance is an outcome of what processes the AMC and the fund manager is following. We will never try to go in to rate them based on performance. We have always, so for the funds that we invested in during the 18 to 21 cycle, they were not at all rated. There was no rating on those funds. Ratings are backward looking. We never look at we backward is just to see what has happened, not what will happen. Right. So they come with a lot of experience, the fund managers. Right. So we try to understand, okay, why that level of underperformance has happened, if there is, right? Okay, how is the current portfolio position? How have they been able to manage that entire phase? Right. So for example, Franklin as a house has been battling that debt problem on the equity front, because they were seeing redemptions, because the debt crisis happened. Right. Equity had nothing to do. It was equity is completely liquid. Right. So that did not take away the skill or the ability of the fund manager to perform. Right. So we don't just judge them on performance. You cannot judge somebody just based on performance. Coming to your last answer, I've got fund suggestions which is same as others, even though I'm investing for wealth generation without any particular time frame. I don't understand. Okay, there was data published a month ago about how the minimum experience of the fund manager. Listen, that's not the right thing. We saw the data, and it doesn't look right at all. Right? Why? Because there are before they become a fund manager, they are an analyst. They are an analyst for years together. Right? And then only that bump up happens to them. So it's not that they have never seen a cycle. They have been in the cycle. They know how the cycle is working. Now is that time for them to go out and start putting in that money. But analysts are always given that many number of years, and then after that, uh, is where they have their own set of processes where they have to it's growth for them, right? It's development that happens for them before they become a fund manager. So they have enough experience working with the previous fund manager also, and working with the entire team. So it's not that just because it's 1 year that they have not seen a cycle at all. No, they are an analyst before they become a fund manager, and there's a lot of development that goes into that, right? So in the team we are also, quasi analysts, quasi fund managers, right? So it's always like that. It's how the industry is working. But when we see this level of published data, it's not the full picture. I would only say that it's not full pictures. I have this feeling for active funds that there is a role or ask from government with respect to making a percentage invest in small and mid caps. Is this correct understanding? See, the mandate for investing in a flexi or a multi is that there has to be some percentage going into small and mids. Right? In the 18th cycle, even a large and mid cap fund was doing more small and they were doing more mid. There was no cap, right? So they brought in a lot of caps that, okay, this particular fund category has to invest this much in large caps, has to invest this much in mid caps. So the multi-asset has to invest this much in, equity or debt and precious metals. Right? So that level of work is already there. Okay, considering the geopolitical situation we are facing, any plans to advise overseas funds? Overseas funds are shut. We cannot put any money in them. And all the ETFs that are currently trading, be aware they are trading at a premium to the NAV. You're paying a 20% premium to the actual NAV of the entire fund. Funds are shut. You cannot put any more money into it. But the ETFs that are currently trading, they are trading at a premium. So be aware, be careful. We are not venturing into it. In fact, a couple of days back, last week, we cut out all whatever we had on the older NASDAQ position that we had. We cut the whole thing off. Debt mutual funds right now, SIP. Yes, debt mutual funds is a very good option to choose. If you want to know if it suits your appetite, risk appetite or not, and for what goal we have to invest in, just get in touch with us. Just send us a hi on this number and our team will get in touch with you. Debt mutual fund is a good option. And how much has to be as a percentage of debt, as a percentage of your entire asset allocation, your household allocation, please get in touch with us. We will definitely be able to help you out on that. And debt requires a sense of urgency. It's not like equity. I'll see and try to time it, and those biases don't come in debt because once the flows come in, once the yield goes down, you'll not get that yield again. We saw it in 2018 after IL&FS DHFL crisis, where AAAs were trading somewhere at some 9.5 and all. That's unlike usually they trade at 5% or so, say 5.5, 6% or so, right? So that we were able to that sense of urgency was there on the debt part. Hence, we were able to jump right in and lock in yields at 9.5% or so. Till 2022, we never had any complaint that. And even during the fall, wherever we were managing debt portfolios in 2020, the entire equity was down, but their portfolio was just rock solid. Right. So this is a good scenario for debt. Very good opportunity for debt. We've done a couple of webinars on debt, highlighting the opportunity that's there. And now is a good scenario for debt to play out. Given our macroeconomic conditions, we are on good footing. So for us, definitely debt is a good option. Just send us a hi. We'll help you out. Thanks. I've been with M2W for the last 2 years. I must say the experience was great all the way. Thank you so much for your confidence. Thank you so much for staying on for 2 years. I really appreciate that we've been able to. You are very satisfied with the level of work that you're doing. Thank you so much. My only suggestion to you would be please do get in more people, because this level of work is not something that we are only doing for you. We want to do this for everybody. Our goal is that we should have 1 lakh investors like this, where everything is going as per a particular plan. Everything is going. It should never be directionless. There has to be direction that should be given to an investor. Otherwise, 2 years like this will just like markets like this. If it stays for 2 more years, these questions, should I I'm at a loss? Should I do it? They'll not be aware of what they need to do. Actually, it's a dent on their wealth creation journey. Right? This whole endeavor for us to set a 1 crore target is just a start. Once you achieve 1 crore, after that 10x from there is 10 years from there. Right? So it's just the start. Right? So if I invest the entire amount that I can allocate for my MF and new attractive revenues come, then how can I invest? No catching everything. No catching everything. Today's attractive is definitely there. First you get the today's attractive, then we will think of later. There will be more options coming in. There will be many coming in. Right? So don't worry too much about that. Right? It's not that this is the only money you will have. Right? You will also have income to come in from your part. First, you take advantage of today's opportunities. Don't think of tomorrow's opportunities and miss away today's opportunities. You miss out today's opportunities, again at that point you will have the same bias, no, I didn't do, and then when the wrong time comes, you'll want to go all in. I'll miss out, the market is going up. Don't put yourself in that scenario at all. Your role is to always have money that you should participate. Right? So now you have the entire amount, right? And we are doing it more on a staggered manner. We don't put all the money in one go unless until last week, probably that's these scenarios come in where we put, we try to go a little bit more than what we usually are comfortable with. Right? So first thing is to get the opportunities currently. Right? And we understand that if your financial position is not that you can participate during the year, then we stagger out the investments where we can take advantage of this whole scenario. Right? And where we want to invest in undervalued parts of the market. It's not in overvalued parts. We are not trying to chase anything. Right? We only are looking to build more and more in undervalued parts of the market where the fundamentals are improving and the valuations are low. Most of the negatives are already factored in. So downside is well protected. Only that. Okay, I've been investing personally for 7 years, but still can't understand the conviction to invest in debt funds compared to gold and silver. We heard the same thing for when we were wanting to invest in gold and silver. That why is there a conviction on gold and silver and not in debt and not in equity? Right? We did not expect gold and silver to perform 30-35% or in a year. This has happened very strong, very good return, very strong has come. Returns happen, but it's on the volatile way up. Right? We understood the fundamental logic of having a precious metal that is limited in nature and an alternate currency, basically hedging against all the inflation, hedging away everything. Somebody said hedge, right? I'll use that word hedge. No, but that did not take away the attractiveness of the particular category. Right? We did not see this as a hedge. We saw it as it is attractive. It's not going to go away. We need an alternate alternate currency that will hold our purchasing power when the time is right. And it proved to be that way, just that it went above many expectations. Likewise for debt. If India has to grow, and today the yields are pretty attractive in terms of debt. Why? Because your cost of borrowing needs to come down if India has to do private capacity addition and all of it. Right? So you're competing that way with the global central banks. If they cut the rate, then liquidity is there. They'll corporates will go there. So we're competing there. Right? That's one. Second, FPI, that is FIIs, have been buying debt left, right, and center for 2023, 2024. Right? They've been selling and going there. It's not that they've sold out of India. No, they've gone towards debt. right? And that data, Google and see how much of flows and went in into debt. The same level of flows we saw somewhere between 11 and 12, if I'm not wrong, uh, where they were going towards debt. So that's second. Third, uh, if India has to manage fiscal deficits, which is what the target is, 3.33.5% or so, and we bump up a notch in terms of credit rating, naturally money will flow here. Right? So debt as an opportunity can solid give you good protection. But if my goal is really long term, will see it's not about just because it is long term doesn't mean we have to stick only to equity. Yeah, the overweight needs to be on equity, but during that period we have to make sure that the returns that we're able to make, we're able to protect them, right? So that's why we have a multi-asset approach. Look here, I think that was a slide that's why we have a multi-asset approach. Not that okay, equity will do which we should do. There has to be some good amount of downside protection so that we can sustainably create wealth in the future. 15 years is a long period. Multiple shocks, multiple blows can come, short and long. So there has to be good amount of protection in the portfolio. It doesn't mean that we have to go 100% debt. No, there has to be some component that goes towards these asset classes, given your risk appetite, given your. That's why it's all tailor made, right? So that ultimately gives us purchasing power. Today, the drawdowns in M2W are not very high because of the overweight on gold and silver, right? So we have to manage and we have to be consistent as asset managers so that the experience for you is not ruined. That's the logic. Returns is something that being a disciplined investor, being consistent itself, you saw the number, right? You will anyways get it. But the drawdowns is what minimizing the level of risk and still able to achieve that return where you're taking 100% risk is should be given credit. That's what we look to do. Right. I have enough exposure to bonds. Should I have exposure to debt funds? Let's review your bonds. We don't know when it's maturing. Just send us a hi, just send us all these details. We'll see it based on when it's maturing, what is the quality of the bond, and see if it's and given your tax bracket, whether what we need to do. Just send us a hi. We'll review the bond as well. And I have 1 more minute for Q&A, and then I'll close. We have to head into another webinar. I hope to see you all there on the other webinar, which is exclusive for investors on Milestones2Wealth investors who we are working with. Right. Thank you and appreciate for carrying out. No issues. We can have further conversations also offline. No problem at all. Just get in touch with your point of contact. Just tell them that you won't have a conversation with me. You can have that conversation as well. Yeah, consider it. No problem. Consider it. Some portion you can consider. I can see yellow hearts. We are already in CSK mode. Still time is there, yeah. 23rd, Chennai, Mumbai here. Okay, done. Perfect. Thank you all so much for joining in on a Saturday morning. Have a great day ahead. Thank you all. What is the next webinar is about the consumption fund and the consumption theme that you're investing in that I spoke to you about the previous webinar, which was when during the the topic was should you not worry about the market. It was on that. It will be a very candid Q&A. I'm hoping for that. All right, done. Thank you so much for joining in. Thank you.